Welcome back to third session of chapter 4. We will be doing question number 59. So let me read out the question. A and B are in partnership, sharing profits and losses in the proportion of 2/3 and 1/3 respectively. Their balance sheet was as follows: cash rupees 600, sundry debtors 9,000, stock 13,200, plant and machinery 2,400, sundry creditors 600, employees provident fund 600, bank overdraft 9,000, A's capital 9,000, B's capital 6,000. They admitted C into the partnership on the following terms: C to purchase 1/4 of the goodwill for rupees 1,800 and provide rupees 6,000 as capital. C brings necessary cash of goodwill and capital. Profit and losses are to be shared in the proportion of 1/2 to A, 1/4 to B, and 1/4 to C. Plant and machinery is to be reduced by 10% and rupees 300 is to be provided for estimated bad debts. Stock is to be taken at a valuation of rupees 14,964. By bringing in or withdrawing cash, the capitals of A and B are to be made proportionate to that of C on their profit sharing basis. Prepare the necessary ledger accounts and the opening balance sheet of the new firm. So look here, in this problem, there are increase and decrease in the value of assets and liabilities that you already know, but in the last part of your additional information, it is already decided that the partner's capital is fixed based on the profit sharing ratio of a new partner. That means how much capital is brought in by C, that is new partner, will determine how much partner A and B's capital should be, or how much they have to contribute towards the capital of the new firm. Let's see here. On the revaluation account, on the credit side you have by stock. Stock was increased by 1,764. And plant and machinery is 240. The provision for debts is 300. So there is a profit of 1,224, which is distributed between A and B in their profit sharing ratio, old profit sharing ratio, that is 2/3 and 1/3. So this is the profit that is earned by A and B. Capital account. In your capital account, that is on the credit side, you have balance brought down, the old capital of all partners 9,000 and 6,000. So profit on revaluation next is 816 and 408 by premium for goodwill. This is the value of goodwill that has been brought in by the new partner, which is distributed between all partners in the ratio of 2:1. That is 1,200 and 600. So by cash, this is the cash that has been brought in by A and C. How this 984 comes, I'll explain later. And then on the debit side, this is the cash paid to B and also the balance carried down. Now the capital position of the partners have been changed. That is 12,000 for A, for B it is 6,000, and for C it is 6,000. Which means here, I'll show you this particular, you please note the last entry and this first entry. I'll explain this in your working notes. That is 984 cash that has been brought in by A and cash paid to B is 1,008 rupees. This I'll explain later. So one working notes before we prepare balance sheet is cash account. So cash account is by B's capital account. That is cash that has been paid to Mr. B is 1,008. And also on the debit side, the balance brought down 600, that is already in the cushion. Then to A's capital account 984, that is brought in by A. To C's capital account, that is 6,000 capital that is being brought on by C. To premium for goodwill, that is the amount of goodwill that is being brought in by Mr. C, the new partner. Next is balance sheet. Balance sheet. On the asset side, it is cash that we have already prepared just now. The balance carried down for cash I haven't explained, but it will come to 8,376. Debtors are 9,000, and the provision. Provision is given as 300. So now the total debtors comes to 8,700, and the stock. I'm sorry, here the value of stock I haven't entered here, but stock is 13,200. 13,200. So there is a plant and machinery that is 2,400, which was depreciated by 240. So the plant and machinery stood at 2,160 now. It has been already decreased. Now on the liability side, you have sundry creditors 600, employees provident fund is 600, bank overdraft is 9,000, and the capitals amount is 12,000 for A, 6,000 each for B and C, which we have already carried down in your capital account. Working notes. The question clearly states that in the last additional information, by bringing in or withdrawing cash, the capitals of A and B are to be made proportionate to that of C on their profit sharing basis. That means the share of C is The share of C is 1/4. But his capital is 6,000. So we will have to find out how much the aggregate capital amount should be. Since he brings in 6,000, we will have to find the total capital of all the partners, that is 4/1. So it comes to 24,000. So this 24,000 has to be distributed in their new profit sharing ratio between A, B and C. So A got 24,000 into his new share is 2/4. So his capital should be 12,000 in the new firm. And also for new capital for B is 24,000 into 1/4. His new share is 1/4. So it will be 6,000. And also for C, the new partner, it is already stated in the question that he brings in 6,000 as his capital. So this is how the capitals are fixed. So you will have to compare how much has been brought down in the capital account of partner A and B. So partner A has 12,000. And there was some shortage where he brought in some cash, that is to make up to 12,000. And also partner B was 6,000, but there was an excess, so he was paid 1,008 rupees to bring down to the 6,000, and partner A was paid certain amount to make it up to 12,000. This is how the new structure of the capital has to be distributed among the partners of the partnership firm. Next is, let's solve question number 75. Let me read out the question. The balance sheet of X and Y, who share profits and losses in the ratio of 3:2 at 31st March 2014 was as follows. On the liability side, you have creditors, workmen's compensation fund, then provident, employees provident fund, general reserve, then X capital and Y's capital. And on the asset side, you have cash at bank, debtors, less provision, stock, investment, patents, goodwill. They decide to admit Z on that date for 1/4 share on the following terms. A. New profit sharing ratio will be 6:9:5. Z is to bring in capital equal to 1/4 of the total capital of the new firm. Goodwill of the firm is to be valued at 4 years purchase of the average super profits of the last 3 years. Average profits of the last 3 years are 42,000, while the normal profits that can be earned with the capital employed are rupees 18,000. No goodwill is to be appeared in the books. Z brings in rupees 14,400 cash out of his share of goodwill. Balance to be written off to 1,800 and stock is undervalued by 1,200. 20% of general reserve to be transferred to provision for doubtful debts. Rupees 5,400 included in sundry creditors be written back as no longer payable. Out of the amount of insurance which was debited entirely to profit and loss account, so rupees 6,000 be carried forward as an expired insurance. Unaccounted accrued income of rupees 1,200 to be provided for. A debtor whose dues of rupees 6,000 were written off as bad debts paid 80% in full settlement. A claim of rupees 3,600 on account of workmen's compensation to be provided for. The market value of investment was rupees 54,000. Half of the investment were to be taken out by all partners in the all profit sharing ratio. Prepare the revaluation account, capital accounts of the partners, and the balance sheet of the new firm. So there are a lot of adjustments which we will be discussing one after another. Revaluation account. On the credit side, you have by sundry creditors 5,400, by prepaid insurance 6,000, by bad debts recovered 4,800, which means for bad debts it is already clearly stated that 80% has been already recovered. So 6,000 of 80% is 4,800. By stock is 1,200. By accrued income is 1,200. Income that is being earned but not received. And also on the debit side you have to balance 10,200, to investment 6,000, to capitals account there is a profit of 2,400. So in their all profit sharing ratio it comes to 1,440 and 960. And capital account by balance brought down, that is the all capital, that is 1,800,000 for X, and for Y it is 67,200. By general reserve, that is it is already general reserve is 24,000 minus 20% which has been transferred to already transferred to provident fund. That is, when you divide this amount, X gets 11,520 and Y gets 7,680. We'll continue this, but before that let's look at the debit side of your capital account. The goodwill that is already existing in the books of account has been distributed or written off by the all partners in their all profit sharing ratio. So X gets 28,800 and Y gets 19,200. To investment investment fund has been distributed between A and B, X and Y, that is 16,200 and 10,800. To X capital account, that is 4,800, which was compensated by the sacrificing partner, gaining partner, Y. That I'll show you in the working notes. Next is on the credit side, it is by revaluation account. Revaluation account profit was 1,440 for X and 960 for Y. And also workman's compensation fund is 14,400 minus 3,600. The remaining amount is distributed between the all partners in the all profit sharing ratio. It comes to 6,480 and 4,320. By premium for goodwill, that is 14,400, and also by Z's current account 9,600, and by Y's capital account 4,800. By bank account, that is the capital brought in by new partner, 49,800. So to balance carried down, this is a new capital figures. That is, now the capital for X is 1,04,040 and for Y is 45,360, and for new partner is Z is 49,800. Now balance sheet. In your balance sheet, on the asset side it is cash at bank. I will show you this in the working notes. Actually the cash in bank as per the old balance sheet is 12,000, but it has been increased with the coming of a new partner, with the admission of new partner. Therefore the cash now stands at 81,000. This we will have a separate working notes. Debtors was 78,000, so there was a provision of 10,800. Now it has been reduced to 67,200. Here I am not showing how these stocks are depreciated, but you will have to deduct the amount of depreciation. So the stock now stood at 37,200 after depreciation. Investment stood at 27,000. On the liability side, it is creditors 21,600 minus 5,400, 16,200 now, and employees provident fund is 12,000. Workmen's compensation fund is 3,600. Bad debts on the asset side stood at 1,800. Prepaid insurance is 6,000. Accrued income is 1,200. Z's current account is 9,600. So the capitals, as we have already calculated in the new capital, in the capital accounts of a partners. Now it's A, X, Y, and Z stood at 1,04,040, Y 45,360, and Z 49,800. Total comes to 1,99,200 for all the partners, including the new partners. So in the working notes, we will have to calculate sacrificing ratio and gaining ratio. So for X is a sacrificing partner, that is 3 by 5 minus 6 by 20. His sacrificing ratio comes to 6 by 20. Y is a gaining partner, so 2 by 5 minus 9 by 20, he is gaining 1 by 20 out of on admission of a new partner. Firm's goodwill is super profit into 4 years purchase. That means the super profit is already mentioned in the question. It is 42,000 minus 18,000, which is supposed to be earned if the capital is employed, into 4 years purchase. That is 96,000, which is the firm's goodwill. So the Z share of goodwill is 96,000 into 1 by 4 is 24,000. So Z, the new partner's share of goodwill is 24,000. So Y's share of goodwill is 4,800. That is, Y is a gaining partner. So his share out of 96,000 is 48,000. This has to be compensated to the sacrificing partner, that is X. Partner X, where we have already done in the partner's capital account. And also Z's new capital account is 1,04,040 plus 45,360 into 1 by 3. That is, his new capital should be 49,800. The question is silent about the figure of new capital for new partner, but you will have to calculate out of the capital of partner X and Y into his share. So you will get 49,800. So how do we get cash as 81,000, whereas the cash balances is only 12,000? Let's see this. Cash account to balance brought down is 12,000. That is already in your question. Then to Z's capital account is 49,000. The cash brought in by new partner. To bad debts recovered, that is 80% has been recovered. So it is 4,800. To premium for goodwill, that is the goodwill brought in by new partner, 14,400. So all together of this, the balance now stood at 81,000. So this will go to your balance sheet as bank balances. So with this, we have come to the end of this session. Thank you.